Hello, everybody, and welcome to the Tradition Mortgage Podcast. I'm your host, Mike Greenlay, along with my co-host, Erik Hendrikson, president of Tradition Mortgage. And once again, we have another special guest that we will introduce in a couple seconds here. But Erik, so far, we've seen, again, the markets responding to what's going on in the world as they do. And are they now behaving like they're supposed to? Because I know there's been some times where we've seen them really not behave like we thought they would.
Yeah, it is a return to normalcy, is what I would describe it as. Because of the pandemic and the disruptions in the market, we did see interest rates go down to uncharted territory, lows that we had never seen before. So we did enjoy a tremendous run over the last 12 months, but it's pretty amazing how almost on the 12-month mark exactly, we've sprung back up to where we were, which seems like a big jump to us, which it is, but the good news is we were at historical lows, a year ago, so we're kind of back to those, a little bit of normalcy. The market's functioning in a more normal way. Bond investors that really drive the mortgage interest rates are starting to look at long-term inflation as a main factor for things versus, disruption due to the pandemic. So again, a little bit of sadness on the mortgage banking side to see the refinance market dissipate a little bit, but good news overall that we are returning to more of a normal world.
Thanks, Erik. I want to bring in now our special guest, and it's Dan Smith with Tradition Mortgage. He's the head compliance officer. Also in charge of loan eligibility guidelines. So there's a lot there. You do a lot of different things, but just wanted to welcome you in and kind of, can you give me a quick overview of some of the major things that you have to handle as a compliance officer and a guy who looks at all the guidelines?
Absolutely. Well, gentlemen, thanks for having me here. Yeah, we operate in a very regulated industry. We're regulated on the federal level, at the state level. Each different state that we're licensed in, which is 6 right now, have different rules and regulations that we have to follow. So we have to balance all of those. We have a pretty large set of investors that we sell our loans to, and then we have. And is that we have regulations from Fannie Mae, Freddie Mac, FHA, VA, USDA, who are the other places that are involved in our industry very heavily. So we have to balance all of the different and also the constantly changing rules and regulations from all of those different places. So we have to kind of follow all of those, and they all play into each individual loan that we do. So we have to balance all of that on a daily basis.
Pretty simple.
Yeah, it sounds very well, and I know we joke about that, but the truth is, Dan, is so if I'm a client and I'm looking at all of these guidelines and regulations and everything, has that gone up considerably in the last few years? Do you find yourself just inundated with more rules and regulations and paperwork and everything else? Because I think the consumer, the client, they probably feel that way. Yeah,
it's been kind of it's ever changing. As different administrations, whether it's on the local or the federal level, different administrations have different goals that they try to accomplish. So rules and regulations change over time. During the 4 years of the Trump administration, things changed than they were the previous 8 years under the Obama administration, and there's expectations that things are going to change pretty significantly over the next 4 years under the Biden administration. Now, in addition to that, we saw, I would say it's interesting the time we're talking right now, 12 months after the onset of COVID. When that happened and there was massive disruption in our industry, Erik's talked about the bond market and interest rates responding to that. On the back end, on the qualification side of things, there was huge changes there. Fannie changed things, Freddie changed things, FHA, VA, everybody changed things pretty rapidly. So last spring, March, April, May, there was massive changes. Some pretty big implications, credit scores. There was more criteria from different investors on who could and who couldn't qualify based on their credit. Self-employed borrowers probably faced the most intense scrutiny over the last 12 months. Previously you were looking at tax returns. Maybe you'd need to get some updated financial information, but now things are very, very up to date and very, very scrutinized, looking at profit and loss statements. So it's become much more challenging to qualify if you're self-employed. So it's always changing.
So Erik, as someone who is a business owner, and especially in this market and with this industry, how do you differentiate yourself from the other companies? Because obviously it's industry wide, so everybody faces the same type of scrutiny, the same type of rules and regulations. But how does Tradition Mortgage separate themselves, and how do you manage that going forward?
Well, thanks, Mike. No, it's a good question. Really, in a heavily regulated industry like mortgage banking, your ability to just innovate on your own is very limited, right? We might think, hey, I have a good formula that I can look at to decide who can qualify for a mortgage, and I might be perfectly correct in thinking that, but ultimately I can't act on that because there's documentation, there's items that I need to get that are set forth by governing bodies. So, to me, really to differentiate, it's kind of two kind of main criteria. I would say, first and foremost, using our experience as mortgage lenders and our average tenure is over 2 decades for our senior loan originators, using that experience, really analyze the customer's situation and really match that up with a loan program that makes sense, that works, and kind of get the train on the right track right away. So really that expert analysis on the front end to really make sure somebody is in the right program, that they meet those initial guidelines, so then the whole rest of the process can be smoother and you're not trying to pound a square peg in a round hole. So that experience is huge. And then secondarily, there is no getting around, several financial documents and items that we need to get, and the disclosures and paperwork items that need to be signed off by the customer. So for us, we look at it, how can we use technology as a way to create a delivery method that's more digital, so you limit the amount of actual paper that people are having to push around. So we've really invested heavily both on the front end, mobile applications. Our online application is user-friendly, really digital disclosures, and right up to the point of our actual loan closing, we're able to use a digital loan closing process. So there's only just a few handful of notarized documents that need to be signed at closing. So really using the best-in-class technology married up with very solid advice on the front end by our expert loan officers. Really, those two items put together really are the differentiating factor. Some people think if I'm going to go with a digital mortgage, it's online and it's all do-it-yourself, and I don't have that expert advice. Or if I want to get expert advice, I have to kind of go old school, and it's going to be a longer process and more manual. We're here to say that, hey, Tradition can give you the best of both those worlds.
And it seemed to me, and you guys can both chime in on this, but it seemed to me everyone's lives changed with COVID, but it seemed to me that you guys were already taking the step into the technology side of things before. It just maybe COVID exacerbated that, made you guys jump a little bit quicker into it. Would you agree with that?
Yeah, absolutely. I think we've been focused on technology and the consumer experience for the last couple of years, balancing the rules and regulations that we have to operate within. So I would like to think, we were maybe a little ahead of the game, but it kind of bounced the entire industry ahead, obviously us included. But I'd like to think that we've done a really good job the last few years to try to make the process more efficient and user friendly.
Yeah, well, I would say that COVID changed a lot of things. We certainly wanted to make, focusing on the closing process, we wanted to make that a little more simplified, get people in and out of a closing faster so they're not sitting there signing document after document. Mm-hmm. But with COVID and the safety concerns associated with, personal interaction, that just put that in a hyperdrive. So okay, if they can sign in a digital environment from the safety of their home, that's, to us, we want people to still want to go forward with the loan process, where we don't want people opting out just because they're afraid for their own safety. So that certainly is one kind of main area that I could say really changed quite a bit. Just the focus, just like in the workplace, hybrid work environments where people are working from home more. I mean, certainly COVID made us realize that in a lot of ways, if you create a more digital environment for mortgage lending, it's what people really want.
Mm-hmm. It's interesting. If you were just to be an observer of a mortgage office, especially Tradition Mortgage, it's like a beehive. I mean, there's activity everywhere. There's people running around doing things, phone calls, all kinds of stuff. But it always strikes me as interesting when something in the industry kind of lands that morning, and it's like the activity just jumps up a notch. And the other day there was some talk about second home or vacation home and investor pricing and things of that nature and all of a sudden there's a flurry of activity. So I would love for you guys to kind of outline what that was and what it means to the consumer.
Sure. Well, I can try to break it down. It's a little muddled, but I'll try to keep it as simple as possible. So the vast majority of the mortgages that people take out are what's known as conventional loans, and they actually are purchased by two big entities. They go by the acronyms of Fannie Mae and Freddie Mac, and these are big companies that actually are in they're overseen by the government right now after the last financial crisis. But these two large companies basically buy all these mortgages from banks and independent mortgage lenders like Tradition, and they bundle them up into bonds and they sell them on the bond market as mortgage-backed securities. So they kind of create this syndication process, and that allows the United States, homeowners, borrowers to access the capital markets throughout the world. It's really an amazing process that creates access to capital and very low interest rate loans for our customers. But anyways, Fannie Mae and Freddie Mac, because they are overseen by the government right now, they do fall under kind of the jurisdiction and the whims of the government. And now, in a little bit more conservative stance, they're looking at, okay, what risk do they really want Fannie Mae and Freddie Mac to take? And certainly in this super low interest rate environment, those portfolios have ballooned up a ton. They're taking on a ton of mortgages. So they're saying, okay, how can we limit risk inside of this massive portfolio? And they look at, okay, what are the, if the economy turns, things happen, what are the loans that are going to have a higher level of default risk? And by definition, non-owner occupied investment property loans, those are generally going to be the ones that you're going to see some defaults in, and then second homes as well too. Generally speaking, a primary residence, a person's going to try to do whatever they can to continue to make payments on that mortgage. So kind of, they step back and they said, hey, we want to limit the amount of these non-owner occupied and second homes in our portfolio, so we're going to put a cap. So, us as a mortgage originators out there, we're like, okay, how do we deal with that? How do we account for, potentially going to sell that loan to Fannie Mae, and they say, you know what, we're full. So, okay, we got to find an alternative place to sell that mortgage. So that uncertainty resulted basically overnight in those interest rates for those types of products to spike up, in some cases, 0.5% or more. So we really aren't sure long term exactly where pricing is going to settle for those investment properties and second homes, but rest assured it's going to be higher because, basically the government, Fannie Mae saying, private marketplace has to step in, private lenders are going to have to step in and be the buyers of those types of loans. So definitely, I can understand the rationale behind it, but again, in classic government, fashion, they come in and just announce things and they don't have any guidance, and there's really no way to really account for it in a strategic way. So here we are, and those people are out there that are shopping for cabins or buying investment properties. All of a sudden it got more expensive, and certainly for investment properties where it's a business and you're trying to figure out, okay, what's my mortgage cost, what are the rents that I can take in, certainly that's going to have an impact on demand for those rental properties going forward.
So Dan, as someone who, as I mentioned, looks at compliance issues, looks at the guidelines that people have to have, how flexible do you have to be? Because it just seems like Erik just said, sometimes they'll just drop an anvil in your lap and say, here we go. This is the new method, or this is the new, and how do you guys adjust so quickly? Are you just used to it now?
Well, we've gotten used to it over time, and especially over the last 12 months, it seems like things were changing. Well, they were changing on a daily basis, and we've also seen over the last 12 months that that the time frame to implement changes has shrunk. In the past it would be you'd have 90, 120 days. They would announce a change, and you have that time frame to get your staff trained on it and get used to it. Over the last 12 months, it's sometimes been hey, this is happening tomorrow. This is effective immediately, which I think we can all understand why that had to happen as the world was changing very rapidly. The biggest thing that we do is just communication. We're always communicating to our sales and support staff, always training, updating on exactly what's going on. I think that's one of the things that we're really great at is the education levels of all of our employees and the tenure that they have that Erik was talking about. So, and specific to the changes here on second home and investment properties, in addition to obviously being more expensive, I think the ability to qualify for them is going to change. If Fannie Mae and Freddie Mac aren't going to purchase and keep those loans in their portfolio, if it's going to have to be more private players that are in the game for those specific types of loans, I think you're not going to be buying a second home, with only 10% down. Places are going to look for 15, 20, even 25% down for people buying a cabin, since it's not going to be their primary residence. Same thing downstream with investment properties as well. Probably some significant changes we'll see there, and I think that'll play out over time here. But either way, it's going to make both those types of loans a little bit more challenging for everybody.
We joke in the mortgage business that the only constant is change.
Yeah,
I mean, it is just change management. And I guess that if I had to, title for this podcast, just dealing with constant change. I mean, that's what we do, and having very experienced, both on the sales side and operational side is huge, and having someone with the expertise of Dan on staff with us here is a huge benefit for us. So again, as things get more complex, and the industry continues to get more difficult, that experience becomes more and more important. People kind of think of mortgages as kind of getting commoditized, but I would say it's really the opposite of that right now. You really need an expert.
But it's made you guys better, hasn't it? I mean, you look at a lot of these things and you could look at it and say, man, that's a negative, or boy, they went and changed the rules again, or, but that kind of flexibility, or forcing you to be flexible, how's that made you guys better as a company?
Well, it forces you to be nimble. You have to be able to pivot. So I always talk about, staying athletic, right? Keeping your knees bent.
Your knees bent, yeah.
A lot of these companies, they get bigger and they just kind of die under their own weight. Yeah. They're dealing with turnover and staff the bigger you get. And that's where, for us, our turnover rates are virtually, zero here in an industry that, people kind of jump around a little bit. So that really, again, to be able to navigate change effectively is a huge, important element, and we nail it. So again, we kind of say bring it on. Nobody enjoys dealing with the headaches and the changes, but it does continue to help separate us from the competition.
Mm-hmm. Well, guys, once again, just some good details, some very interesting stuff. Like I said, to the layperson, this is there's some information there. I guess people need to understand that there's a lot to it. It's like it's the proverbial duck. Very calm above, but underneath the water is swimming like mad, and it seems like that's what the mortgage industry is given.
It really is, and it's kind of what's saying, don't hate the player, hate the game. And then I would tell people, we're a conduit to the capital markets for you. We're not, it's not our grand idea. It wasn't Dan and I sitting in a room coming up with these underwriting guidelines. We're kind of we're the river raft guide. I always say, I can't, there's boulders in the river. I didn't put them there, but I'm going to try to steer you around them as best I can. So, kind of working with your loan officer and not against them. We're going to do everything we can to give you sound advice, and then we're going to, ask you to, help us help you through the process. But we'll stay in communication. We'll make it easy for you to get the documentation to us that you need. We're going to see it through. We're going to get you to closing.
Dan, thank you very much for joining us. Some great information there, and I know you're going to be busy with a lot of the guidelines and details that they keep throwing at us. And Erik, once again, thank you.
Appreciate it.
Yeah, thanks, guys.